shall be continuing our series on quick valuation by looking at the price ratios today. It's just a quick way to value a stock before you really dig deep and see if this stock is going to really work for you. It's like a sieving mechanism. Right. Look at this. We are talking about the boom and bust cycle again. Recap. Remember in our series we said at the start of a boom, prices are very, very low, and then when things actually pick up, price of asset begin to go right up and up and up until it gets to a level that is not sustainable, and then it tanks. It starts tanking right back down. So this forms the economic cycle, what people call the economic cycle. And what you have here, the price ratio, can put itself right in this graph. So in trying to put itself right in this graph, it mirrors what is going on here. So this mirrors what is going on here. Remember, people are buying. That is why these things are changing. So what happens is at the start of the boom and at the end of the boom, price ratios actually change. So here you have a low value, and here just before the end of the boom you have very high values. So price to earning ratio normally changes from the start of the boom to the very end of the boom, roughly about times two or more, or at least times two. So this is particular to only good companies that you have spotted along the way. So what you see here is mirrored right here. In the case of the price to sales ratio, PS, from the beginning of the boom to the end of the boom, what normally happens is price to sales ratio increases by roughly a multiple of 4. So that is how it increases from the beginning of the boom to the end of the boom. It's approximately, it's just like a guide. It's not hard and fast, but it's a guide. For price to book ratio, it really varies. It varies. So when do we use price to sales? When do we use price to earning? And when do we use price to book? You can use price to sales when, especially the sales, the company is in a growth phase. That will make sure you don't miss out on the returns that will come from the growth the company is experiencing. So for me, what I normally term as a growth company is a company whose revenue exceeds roughly 25%. So that for me is a company I call a growth company. Your own may be different. So I use price to earnings ratio when the net income of the company is growing roughly between, let's say, 8% to 20%. So that is where I use my price to earnings ratio for valuation too. Price to book, this is very useful when you are buying at the start of the boom, or when the prices are so low. This is where you want to buy. Let me just give you a quick trick. You try to look for assets that have price to book ratio of less than 1. So if you can look for businesses that have price to book ratio less than 1, good businesses, not just anyhow businesses that have price to book ratio less than 1 during the start of a boom, then you are in for a home run. So that is how all these things change. Remember, I have spoken to you about the issue of 5% change and how a company's revenue just grows, at least it's expected to grow at least 5% because of inflation and population growth. That if it just attains at 5%, it's minimal. So it's not consequential. So it's just there. There is nothing special, except the company is actively involved in maybe reducing the number of shares out there. Then that is where you can see the value of per share earning increasing, whereby the business begins to the share price of the business begins to increase because of the earning per share is increasing as well. So those are ways a company that is flat can actually increase shareholders value by decreasing the number of shareholders. So that is that for that situation. But here we are coming to valuing companies that are good, that have potential for tomorrow to give us very solid returns. So this is key to understanding that framework. Understanding that framework, the phases of the company, by looking at the revenue, by looking at the net income, would give you an idea of what is to be used, of what numbers to be used in valuing that company. It's a quick method that kind of gives you a quick means to valuing these companies without that much guessing the numbers of the cash flow, adjusting this, adjusting that, trying to print the coupons that you want to discount. So you can do that, but in this case, it's like you are trying to, the trick is like you are trying to look at the future of that company, what it will be valued in a couple of years, and then you try to discount that value back down. So understanding that company would help you figure out what that company will be valued at in future, and then you bring it down to today. That is what this particular trick is trying to tell you. Of course, you need to know a lot about that company, its competitive advantages and everything, for you to be able to do that. So that is that for today. I deeply appreciate your watching, and I hope I continue to make sense. Please subscribe to our channels, and hopefully we will see you again. Thank you. Bye bye.